Welcome to the very first Allan Small Financial Show. Thank you to all of you that are taking your time out of a busy day to spend with me. This is the first show, and we're all very excited. I guess the reason for the show and the reason why we started to do these shows every few weeks, we're planning on doing them every couple of weeks, midweek, usually on a Wednesday around the lunch hour. And the reason, as I said, that we're going to be doing this is for the most part, we've been doing a lot of podcasts, a lot of videos, and people have been very excited about these videos. And we thought what we would do is kind of take our videos and our podcast live to the viewers, to all of you, so that you could listen to what we're talking about, explaining about the markets, what's going on, what you need to know in the weeks ahead before you make your investment decisions. And then feel free to ask any questions that you may have. I want to be able to answer as many questions as I can. And if I don't get to your question today, perhaps I can get in touch with you over the next couple of weeks and answer those questions by email. So if you have any questions, please wait till the end of the show, and you can type them in the meantime, but I will definitely get to them by the end of the show. And that's the exciting part. And again, once again, thank you for joining us today. And hopefully you can take some crucial information from what we're going to talk about. On the show today, I want to hit on a few topics, some topics that have come to the forefront in my conversations with some of my clients, some of the investors that I've been speaking to. One of them in particular is understanding your portfolio, understanding where your investments are trading. Do they trade on the Toronto Stock Exchange? Do they trade in the United States? And you see, one of the reasons this has come up is because we're obviously all seeing the negative headlines. We're seeing the Toronto Stock Exchange go down by 300 points in a day, or the New York markets going down by 500 or 600 points in a day. And then quickly we jump to the conclusion that my portfolio must be down. Well, not exactly. If the TSX is down today, perhaps your portfolio isn't. So we're going to talk a bit about that. We're also going to talk about different things that you may own, building a portfolio. We're going to talk about if you had some money to invest today, where should you be investing that money? How should you be investing that money? What type of diversification should you have? So we're going to touch on that as well. And lastly, my take on your questions. What are we going to, what kind of questions do you have? What types of things are you wondering about? How long can this downturn in the markets last? I think that's the question I've been asked most often over the last, I'd say, 4 or 5 months. And we can address that. What's my projections, or what do I think is going to happen in the second half of this year? I think it's going to be a lot more positive than it has been. I know many of you are saying it can't get much worse, but I think it will be positive. I think there are some signs that we could see some positive markets. So let's get on with the show and touch on some of those points. So I talk about gaining comfort and understanding your portfolio. And I always say on my radio show and anytime I'm on TV that knowledge is power. Understanding what you own, it can be very powerful because it makes you feel more confident when the markets are as volatile as they have been. For those that don't understand what they own, perhaps they think they own something that is of moderate risk or higher risk, and really they're not high risk. Or perhaps opposite, you may think you own something that is of lower risk and your portfolio shouldn't be moving a lot. Then all of a sudden you take a look at the portfolio and it's actually moving quite substantially. So understanding what you own, understanding, as I said earlier, where the investments are trading is utmost important for, in my opinion, for investors. If you're not sure what you own, if it's low risk, if it's medium risk, high risk, if you're not sure where the investment is it trading here in Canada on the Toronto Stock Exchange? Is it trading in New York, either on the Dow or the NASDAQ or the S&P 500? That's a question I think you should be asking your investment advisor. And if your investment advisor is not prepared to help in that capacity, send me a message, give me a call. I'd be happy to let you know where your investments are trading. And as I said in the first segment, I think it's important because all of us turn on the TV at the end of the day. Some of us that like to look at our portfolios on a daily basis or even a weekly basis, we look at these portfolios and we want to know, in a snapshot, how we did that day. And when you see a negative headline, TSX down 300 points, the first call I get is, oh my goodness, I must have lost a lot of money today, Alan. How bad was it? And a lot of the time, I turn around and say, actually, it wasn't that bad. There was a day, I think about a week ago, where the TSX lost a few hundred points, yet tech stocks that traded on the NASDAQ were actually up. And for those of you that are watching that are my clients currently or investors that I've spoken to about owning tech stocks, some of the biggest technology names in the industry, if you own those names, you actually fared a lot better than someone who owned some oil or even some Canadian banks. That those were the stocks that actually had a difficult day. So if you were someone who owned tech stocks, you actually had a decent day. Your portfolio either stayed relatively flat or actually maybe even increased a little bit because of your diversification. You were diversified. You had investments in other areas that aren't necessarily prevalent on the Toronto Stock Exchange. So understanding your portfolio, understanding what you own, what kind of risk it is, how volatile it should be, what is the expectation for these investments, I think is crucial. And then understanding where they trade is also crucial. Know that if you see the headline, NASDAQ up 300 points, and you own a lot of tech stocks in your portfolio or a number of the big tech names like Google or Apple, you can really believe that you had a decent day. If you own Canadian banks and the Toronto Stock Exchange had a good day, then you could gain some comfort in knowing that your Canadian bank stocks probably did well as well. So understanding what you own and where they trade, where these investments trade, is extremely important, especially during volatile times. We run a this week video quite often every couple of weeks, and on our podcast we discuss what I believe individual investors should consider over the next 5 to 10 business days. And we like to talk about things either from a macro perspective, so economics, talk about what's going on from a big picture perspective, things such as the war in Ukraine, China's zero COVID policy, or high inflation. Or sometimes we talk about the micro. We talk about specific stocks. We talk about specific sectors of the market that you should be looking at. Well, for this segment, I like to talk more, I guess, on the macro side, but a little on the micro. I think going forward, before individual investors consider making their investment decisions, there are 3 things I think you need to consider or look at. Number 1, the Federal Reserve, central bank out of the United States. Now, some people will say, well, why aren't you saying the Bank of Canada? Well, Bank of Canada is important as well, but we tend to follow what the Federal Reserve is doing. And what the Federal Reserve is doing right now is raising interest rates. And the Bank of Canada is following suit. We know that both Bank of Canada and Federal Reserve have raised interest rates substantially over the first 6 months of this year. So we want to know from the Fed, are they going to continue to raise rates as quickly as they have? Are they thinking about slowing the interest rate increases down a little bit? Will they continue to raise 75 basis points? For those of you that own real estate or considering renewing your mortgage or buying real estate, this is a big factor. Interest rates play a huge part in the real estate market. Interest rates play a huge part in the investment market in general. And so what the Federal Reserve is thinking, what they're saying, this is definitely very important and definitely something that the average investor should consider or keep an eye on before they make their investment decisions over the next 5 to 10 business days. We also want to look at the economic data. What's going on with inflation? Recently, we saw a very high inflation rate reported out of Canada, almost 8%, 7.7%, the highest in many decades. Unbelievable. In the United States, their last inflation reading was around 8.5%. So inflation is running hot, the hottest we've seen in possibly 40 years. Last time we saw inflation this high was in the 80s. And so this is definitely spooking investors, spooking all of us. You can't help when you go to the grocery store and groceries are costing a lot more money. You go fill up your tank, and filling up your cars with gas is costing you a lot more money. Taking a trip is costing you a lot more money. Renting either a hotel or renting somewhere to live is costing a lot more money. Buying used cars is costing a lot more money. Everything around us is going up very quickly and by quite a bit right now. And so this economic data, inflation in particular, is something we want to keep an eye on. We also want to keep an eye on, retail sales. Is the consumer still spending as much money as they were spending before? What's their confidence level? We just saw consumer confidence levels that came out of the US, and we decided that this was a very low number, the lowest we've seen in quite some time, and that actually spooked the markets. It spooked the markets, and so we saw a negative day in the markets, and that didn't help at all as well. So we want to continue to look at the economic data. We want to look at the Fed. And lastly, we are now, I guess, about the midway point in the year. We are at the end of June, another couple of days, and we'll have the end of June, and the midway point of the year. And so what does that mean? Well, it means earnings season will be upon us over the next couple of weeks. What are corporations saying? We usually see the big banks in the US kick off the earnings season. What's a name like JP Morgan, the largest bank in the United States, saying? What are they saying about the consumer? What are they saying about their customers, their businesses that do business with them? What are they saying about individuals? Do they still have as much savings sitting in their savings accounts as they did a few months ago? So I think the big banks kicking off the earnings season will be crucial to set us up for the rest of the earnings season. Names like Microsoft or Apple, some of the biggest names and tech names and companies in the world, what are they saying? And mostly, what are they saying going forward? What are their expectations for the coming quarters, the second half of this year? They may say things were quite weak in the second quarter, but what are they saying for the third and fourth quarter? So earnings, expectations, the Fed, economic data, these are the three things, in my opinion, individual investors need to consider before they make their investment decisions over the next 2 weeks. So if I get the question asked to me again a lot, if I gave you some money, Allan, what would you do with it at this time? There are many people right now that are very fearful to add money to investments, add money to their portfolios, and there are some that have that iron stomach that are willing to add some money at this time because they believe things are cheap, and rightfully so. This is the cheapest we've seen the market in quite some time. A number of good quality investments are very cheap, 25, 30% on sale right now. So I get the question asked of me often, Allan, if I gave you a lump sum of money, what would you do? I guess the answer pretty much depends on whoever's giving me the money. Are they a low risk investor, a medium risk investor? Are they trying to get income from their portfolio? Do they want growth? Do they want growth and income? And these are, I guess, the ways that individual investment advisors look at things. We want to know our client. We call it KYC. Know your client. Understand who they are. Understand what they're trying to do. Understand what their goals for their money, what their goals are. And that is probably the most important question I can ask an individual investor. But let's say that investor is looking for growth and they want to grow their portfolio. They have a bit of a longer term time horizon. Depending on what age they are, 40s, 50s, whatever it is, and they want to grow their money over time. Where should they be putting their money today? My answer to those folks that are asking that question is many different places, really. I start always with the Canadian banks. To me, the Canadian banks have been and always will be the backbone of many of the portfolios I build. You see, because when you look at a Canadian bank stock, it doesn't matter which one you choose. If you look at a chart, it always seems to start from the bottom left and end up in the top right. These banks also have a great history of paying dividends. A lot of them today, such as Scotiabank, for example, pays over a 5% dividend. CIBC pays over a 5% dividend. Even Royal Bank and TD are paying over 4% dividends today. Their share prices have fallen so much that it makes sense to have these types of names in a diversified growth portfolio. As well, they will pay you a great dividend. So you're getting a little income, which also can help grow the portfolio. Manulife, another name, paying almost 6% dividends today. So I think you want to start with the financials. And then I think you quickly want to move to some of the other areas, some of the other big names in different sectors, some of the big tech names, some of the big pharma names. And pretty soon what you'll find is this nicely diversified portfolio with many different sectors. The biggest and best names in each sector are the names you want to own today. These are the names, in my opinion, will protect you if we continue to see downside in the markets, but they will also be the first names that rise when the tide turns. When we start to hear that the Federal Reserve is sort of pressing the pause button on these interest rate increases, the Bank of Canada as well, pressing the pause button, kind of waiting to see what's happening. I think the big tech names, the big financials, the big pharma names, these are the names I think that are going to start to move significantly higher, especially if we see a bit of a slowdown in these interest rate increases. So that's where I would start today. And again, there really is not one particular sector, because I always preach diversification. But I think within all different types of sectors, you'll find the leaders in those sectors, those A quality names. Those are the names, in my opinion, are the names you should own today. And if you have a bunch of names today in your portfolio, you want to look to perhaps upgrade those names. So even if you have a portfolio that's already established today and you're adding new money to it, look to perhaps maybe make a change, sell a B quality name for an A quality name. I used the example with a client most recently, it was Microsoft. I think Microsoft is one of the best companies in the world by far. They have businesses in all the different areas of the economy that I think you want to be in. So a name like Microsoft that was so expensive for so many months and years, today is about a third. It's on sale for about a third of its value, so down by more than 30%. I think that's a name definitely, if you have the risk tolerance to handle a name like Microsoft and the volatility of owning a name like Microsoft, I think, in my opinion, that's the type of name you want to get involved in as an A quality name, and perhaps move some of the money from a B quality name into an A quality name. And lastly, how do you know what the B's and A's are? Well, I think that's where your investment advisor comes in to help you upgrade the portfolio. And that's what I've been doing with my clients. Existing money, I'm looking to upgrade it into some better ideas. New money coming in, I'm looking to put it into those really good, solid ideas. And that's what I'd be doing if I received a lump sum of money from an investor today. So this is the part of the show that I like best. This is a time where I get to answer your questions. If anybody has any questions, please feel free to put them in the comments section. I believe on YouTube there is an area there where you can ask questions. I'm seeing a few questions coming in right now, so I'll try to address as many as I can. And I guess the guys in the control room there, let me know when we're kind of getting to the end of the show and I'm running out of time. So I'll try and answer as many as I can. I'm getting a question here from YouTube. With the very volatile markets, is it safer to cash out your investments and hold for a while? Again, another question I get quite often, trying to, in essence, time the market. We're trying to I guess, move out of your portfolio for the time being, either in full or maybe partially, keep your money on the sidelines, and then move back into the market when I guess things seem a little bit better. That's a very difficult thing to do, very difficult game to play. And as many of you who know me well, that's not something I like to do. I much rather see you stay in this market. And the main reason for that is statistics clearly show us that the best days in the market come after the worst. The best months after the worst months. The best years tend to come after the worst years. Let's take a look at, the year 2009 after 2008 crisis was fantastic. 2019 after the markets crumbled towards the fourth quarter in 2018. This year we're seeing a difficult market. Perhaps 2023 ends up being a great market. So I think you want to remain in this market, but what you want to do is, as I said earlier, move money around into different areas, stay diversified, play defense if you think you need to play defense, perhaps own a utility or a pipeline. But when the time comes to move money into some of the tech names, if you don't already own them, or some of the banks, your money's already there. It's already invested. So I don't think you want to sell out and go to cash, because you're not going to know when to move back in. And by the time you decide it's safe to move back in, market could already run up 25, 30%. And then you're left saying, wow, I should never have gotten out. So moving into cash, I think, is a difficult thing to do, something that I don't recommend. But what I do recommend is definitely moving around your assets, moving around your money, moving it into areas that you could perhaps hide out in while there's volatility in the market. And then when things get a little bit better, you're still invested. So as the market rises, you can benefit from that as well. Let's take another question here. Um, when is a good age to get started in investing? How do I get started? Fantastic question. I think you're never too young to invest, never too old to invest. I get a lot of clients that or investors, they'll tell me, I don't have much time, Alan. My RSP has been converted to a RIF. I'm taking money out, and I can't afford to lose money in the market. So they think their time horizon is very short. On the flip side, there are a lot of people that are just starting out. Obviously, their time horizon is very long. It's people in their 20s and 30s. I think for me, individuals invest to get ahead in life. You invest early in life to save for your future. You invest in retirement to be able to afford a great retirement life. And I think for the most part, people always remain invested. Whether you start to draw money and the rest of the money that you don't draw on stays invested, that may be the case, but you'll always be an investor. And as I said, you're never too young. I know when I was a kid, I guess I'll call myself a kid. I think I was about 23 years of age. I started to invest. I got my first job at the Royal Bank, and I started to invest at that point, and it was great. I got to invest. I think for the most part, I was in mutual funds at that time, but bought the odd stock. And I think I'm better for it today because I did start at such a young age. So any of the young people out there watching today, you're never too young to start. If you have money that you want to start working for you, if you want to, if you have your first job, whether it's a summer job or whether it's a job while you're in university, put aside some money. If you don't know what to do with it, give me a call. I'd be happy to sit down with you. One of the things we talk about is buying things that you're familiar with. If you're a lover of coffee, maybe you own Starbucks. If you love going to Disney, as I do, maybe you own Disney stock. Or if you just want to play it a little bit more conservative, get a good dividend and a little growth, maybe you own a Canadian bank stock. So you're never too young or too old to be an investor. Let's see what other questions we have here. If COVID improves, how will this affect Pfizer once vaccines are not used as much? Another great question. So Pfizer is a company that's been around for many, many years. And they have a lot of products other than their COVID vaccine. But I will tell you that as we start to learn to live with COVID more and more, and we're already, I think, doing a really good job of that over the last 6 to 12 months, I think that could affect the price of Pfizer. I think you could see the stock price fall a little bit, not because they're selling less vaccine or their other drugs aren't doing as well, but the perception that perhaps we don't need as much of the vaccine, that perception might take the stock price down a little bit. And so I think you want to watch for that. But at the same time, when Pfizer comes out with their quarterly earnings, as they will do over the next few weeks, let's take a listen for what they're saying. How are their other drugs faring? There are other big drugs that make them, millions and millions of dollars, perhaps billions of dollars. How are those drugs doing? If you're a company like Pfizer, just like an investor like us, you want to have a balanced portfolio. You don't want to rely on one drug to make your quarter. You want to have the COVID vaccine, but you also want to have other drugs that you can depend on in case those numbers start to fall, that we don't need as much vaccine. So if you're owning Pfizer today, I would continue to own it. It pays a very good dividend for the most part, but I think you want to look to see what they're saying going forward. How are they doing? And I think that's going to dictate how the stock price does. Let's take, I think we got time for one more. With higher interest rates now, should investors consider investing in bonds? So bonds is interesting. It's something that I don't talk about often, at least over the last few years. Quick funny story, back in the late 90s when you could buy a Bell Canada long-term bond paying 7%, yes, 7% interest on an annual basis, and inflation was about 3%, that was a great deal. Everybody wanted to make a bond of Bell Canada's caliber and make 7%, and sold a lot of that bond, sold a lot of bonds back then. I sold so many bonds, they actually started calling me James Bond. And those days are long gone, because over the last 10 years or so, interest rates have been so low that bonds have not really played a factor into much. It was more money you put aside, like a parking lot for your cash, Well, as interest rates have begun to rise, as we all know, bonds is now becoming a factor again. You could buy a 5-year good quality investment grade bond paying 3-4%. Now, yes, inflation is still 7.7%. So if you own a bond and you minus the inflation, you're still in a negative return. So even till this day, I think a lot of people are starting to look more and more at owning bonds. But unfortunately, you're still going to be underwater for owning them. And right now, with inflation as hot as it is, the only thing you're going to be able to own to make that inflation rate or better is an investment in the markets, either through a mutual fund, an ETF, or an individual stock. And until that inflation rate starts to fall, which hopefully it will the second half of this year, bonds are a tough hold. We're seeing interest rates rise, so bond prices are coming down because they work inversely to each other. So if you own a bond right now, you might be actually underwater, even though it's a low risk investment if you own an investment grade bond. So those that own bonds, don't be discouraged. Hold to maturity, get your money back, and then reevaluate the portfolio, where you want to be, how much risk you want to take, because bonds will become a major factor of portfolios. Again, I think it's just a matter of time as interest rates continue to rise and as the inflation rate hopefully comes down. So I think that's all the time we have for this show. If I didn't get to your question, I see a bunch of questions on the board here. I definitely will hopefully try to address them between now and the next show. I want to thank everyone for tuning in. As I said off the top of the show, this is an opportunity, I think, for everyone to pick my brain, ask me whatever you like. We're hoping to have some really great guests in future shows to be able to come on and lend us their expertise. And once again, thank you for spending a part of your day, a part of your busy day with me today. And hopefully I gave you some information, some investment knowledge that you could take away to make your investment decisions. Have a great rest of the week.